Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the latest and in fact the first official cash rate announcement for 2024 from the Reserve Bank and a whole monetary policy statement, some new forecasts to go through and the lot. Really the only question was it going to go on hold or was it going to go up? And we've seen it remain on hold. It's 5.5% the official cash rate. You had some of the bank economists who are picking an increase, questions from the market over, what's been happening at market had been pricing some huge cuts. They've been coming back in recent times and sort of saying, oh gosh, maybe it is going to go up. There was quite a lot of confusion and it felt like sort of one of the more live debates in recent times because it almost seemed to be going the full breadth of things. Could it go up? Could it go down? Could it stay on hold? You've had a bit more of a look through the figures. I mean, what was the bank looking through? How sort of important were some of those factors around the labour market and GDP?
Yeah, for me, the Reserve Bank took quite a balanced view of the data that's come out recently. There was some speculation, particularly around the most recent labour market data, with the unemployment rate not rising very far, wage growth and labour cost growth remaining elevated, that the bank would see that as a bit of a signal that it hadn't done enough in terms of its previous tightening and would either raise today or signal further rate rises. But they have come out and said, we're confident we've done enough to sort of quell those inflationary pressures for now. That's not completely ruling out future rate rises, but it certainly was steering away from them anytime soon. They were also looking at GDP data and saying, okay, GDP was softer than expected, but we're not reading too much into that in terms of potential capacity. They talked about some of the migration risks, for example, how that's could add to demand side, particularly around rents and the housing market, but they do feel that there's adding a lot more on the supply side, certainly reading between the lines that it is helping to cement that labour market easing that's occurring. And critically, they said, look, the labour market is one of those last things to turn when you're looking at the economy moving. And so we're kind of confident or happy to wait for that process to continue through. At the same time, they were still pointing towards the first interest rate cut. If you look at their forecasts, it's not really coming through until mid-2025. So a slightly lower OCR trajectory than previously, but they certainly weren't sending any signals to the market that we haven't raised today, but we're certainly not going to be cutting interest rates anytime soon at this stage.
Well, that's the big thing, right? You mentioned that sort of phrase in the statement around confidence. Like, we haven't seen confident in a statement, I don't think, in a while. Certainly, that was one of the first things I looked at and saw and went, okay, that actually tells you it's a pretty strong tone from the bank. They also sort of said, look, with inflation sort of still outside the box, they sort of mentioned that, they were going to be a lot less tolerant if there were, more of an inflationary spike that came through, for example. But the way I sort of read through those, all the various notes from the bank was they were sort of almost going, the too long don't read was, look, inflation is moderating. We've asked the economy to cool down. It is broadly proceeding in the right direction that we want it to. Sure, a little bit of a difference here and there on some of the absolute numbers from forecasts, but look, it's trending down. That's what they wanted to see. They're not going to be happy if that deviates hard away from things, but again, sort of moving in the right direction, they're happy enough with. I think it's interesting. You sort of I saw some of the comments both before and after the statement over, will the Reserve Bank be hawkish? Will it be dovish? Certainly after the statement, people saying, oh, it was a very dovish sort of view. I actually think that's probably overreading things a little bit. When you look through some of the numbers, you look through some of that analysis, they were, I think, just sort of saying last time having to push back a little bit because they were worried about inflation. They wanted to sort of, puff their chests up a bit and say, look, we are taking this seriously. Coming through to now, they've dropped their official cash rate expectations just minorly. And I think that sort of says that, again, like you say, a bit more of a finely balanced view for when those cuts start to come through. But certainly they're not sort of moving into this position like, yes, we're completely done, tick, we're, about to start cutting. It's a hold your horses, don't get too overzealous. The markets had got overzealous. The Reserve Bank's pushed them back into a better position, and that seems to be all right for now. I mean, at the moment, Gareth, we're thinking an August cut, and I think the question is, will there be enough evidence by that point? And more importantly, how much could the Reserve Bank actually signal that ahead of time, or are they going to have to keep sort of pushing things out, not because they actually believe that forecast, but because they don't want to give anyone any sort of view that they should massively expect a change and especially big cuts coming anytime soon?
Yeah, and I think that is the risk for the Reserve Bank. For example, if they were to come out at their May monetary policy statement and say, oh, we think we're getting closer to cuts now, you could bet your bottom dollar that financial markets would start to price those in more rapidly and sooner, and probably more steeply than the Reserve Bank would ultimately be comfortable with. So I think there's not going to be anything more than maybe a sort of a 6-week signal, maybe at the sort of review ahead of time. The language will just change slightly and give a hint that, yeah, we're getting closer to those cuts coming. In terms of your sort of question around about, well, how much evidence do they have by, say, August this year of whether they can start to cut interest rates? Look, we'll get another 6 months worth of labour market data. I think that will be helpful just to cement the slowdown, particularly in the sort of conversations around how strong net migration is, and how that should start to flow through into slower, significantly slower wage growth and labour cost growth over the coming quarters. If we look at headline inflation, it won't be back within the Reserve Bank's target band. I think if they were to cut in August, it'll be close to it. We're picking it in the second half of this year to be back under 3%. But again, the question is, I guess, for us, when you're thinking about the timing of that potential cut, an OCR of 5.5%, as the bank said today, is constraining the economy. It is restricting economic activity. And if you cut it to 5.25%, say, in August, you are still constraining the economy, just not as much as you were previously. And so there's still enough there, I think, in that sort of interest rate mechanism, even if you do start cutting in August, that it is going to continue to bring inflationary pressures, demand pressures down towards where the bank will be much more comfortable with them. So look, August is our view. There's a risk, fully concede a risk at the moment, that the bank may have to wait a little bit longer, but I think there should be enough evidence building up over that next 6-month period.
Yeah, agreed. And I think, look, a lot of sort of what's happened over the last month or two has almost been the bank reining things in. Markets have gone way ahead of themselves. They needed to bring that back in. And now they're sort of saying, look, we've got that pathway. We've been continuing on the pathway. We are still on that pathway. It's working. It hasn't worked fully yet, but it is working. We're sort of moving in that better direction. Let's let the medicine sort of work. And then, like you say, you can sort of take a little bit off, but not particularly quickly. I don't think you're going to see a sharp change. You're not going to see, cuts on cuts really quickly. The Reserve Bank, I think, will be nervous about doing that, and so they'll take it in a much more sort of restrained manner. We'll continue to assess how all of those things play out, including, like say, the labour market data, inflation itself, what the Reserve Bank says, and how the various sort of metrics evolve on one of our future editions of Econ Talks.